A homeowner's policy can come in many forms, and understanding the different forms will give you a competitive edge. There are forms 1, 2, 3, 5, and 8, otherwise seen as HO, with HO3 and HO5 as the most commonly known in the homeowners market. The difference in these forms are the number of perils that are covered. For example, HO3 covers up to 16 named perils, while HO5 being more generous in coverage. Though there are many components to a homeowner's policy, I would like to cover the major components when discussing options with your clients. First, we will talk about the structure. As you know, a home may be the highest valued investment that a person could own. When this is understood, you can see why a person would want this asset to be properly covered. In helping a homeowner do this, we must first figure out the replacement cost of the property. Note, I am saying the replacement cost of the property, not the value of it. A home should be worth a lot more than the replacement cost. When a property is damaged, land and value of the location still remain intact. So how do we determine the replacement cost of a home? There are many options, but 3 are commonly used. An appraisal. This is done by a professional who is familiar with rebuilding cost. Generally, there is a charge, but may be worthwhile to get the correct estimate cost of the replacement. A contractor. A builder usually would know the building cost and market area labor cost, therefore should be able to provide a good estimate. An estimate guide provided by an insurance carrier. This is a tool designed by industry professionals and generally is used as a guide. Depending on how generic this tool is, the homeowner may want to make sure that they compare it to the market area replacement cost in determining the proper coverage amount. As an agent, I generally like to get an idea of the replacement cost per square foot to compare with the estimate calculator to guide my clients in making the right coverage decision. The personal liability portion of a homeowner's policy covers a client against lawsuits for injury or property damage that they, their family members, or their pets cause to other people or property. This coverage pays both for the cost of defending the client and for any settlement cost. Liability insurance doesn't have a deductible, and most standard homeowner policies provide a basic limit of liability of $100,000 for property damages or injuries. There is also coverage for medical payments under most policies, which generally would reimburse the client for basic medical expenses with a standard of $1,000. This amount can be increased for additional premium. Other potential liability risks can also include cyberspace, slanders and bullying, pool exposures, and much more. In evaluating how much coverage is sufficient, a customer should consider the value of their assets that may be exposed in a liability settlement, such as their home, investment, and even wages. Many believe that if they don't make much more money or have little assets, they are not exposed. However, a judgment can result in an attachment of wages or collected against assets not just now, but potentially in the future. So, unless a customer plans to never be better than where they are today, it may be a better route to pay a little to get the right protection. Usually, when helping customers evaluate their coverage need, we look at their total asset value and try to provide coverage of at least equal value or better, taking into consideration that settlement in a liability situation can include medical expenses, attorney costs, and permanent or long-term damage. This will also be where a personal umbrella policy can be considered for complete protection. Loss of use refers to a coverage that helps the client maintain their standard of living should they be displaced from their home. This coverage will pay for extra incurred expenses such as food, transportation, and basic essentials. Please note, this coverage is only for extra costs incurred due to the loss. An example would be, if you usually spend $200 for food per week, but because you cannot cook in a hotel and have to eat out, your meal expenses increase to $300. The payout will be the difference of $300 minus $200 or $100. Loss of use will also pay for temporary lodging until the principal property is repaired or replaced. Of course, there are limitations. Some companies will limit the coverage by dollar amounts, while others will limit by the amount of time. The second option is generally better as it allows the client to really maintain their standard of living without financial limits. Take, for example, if a policy limit loss of use to $50,000 and the client is out of the home for 6 months, they may find themselves using $50,000 very quickly, and the rest of the cost would come out of their own pocket. However, if a coverage is limited to 12 months with no financial limit, they would be able to take care of rent, extra expenses without the possible concern with any cost out of pocket, as long as the property is repaired or replaced within the 12 months time frame. The limit of this coverage tends to be set by the insurance carrier with limited alternative options for the client. As previously indicated, the best way to describe personal property is to turn your structure upside down, and anything that falls out of it most likely will fall under this category. Determining the right coverage for personal property is just as important as determining the right coverage for the dwelling itself. So how do you help your client determine the right coverage? There are many theories around this. Some would figure out the square feet of the property and come up with an estimate based on common standard. Others will utilize very specific details in an itemized list. The second option, of course, is probably more exact, though the client would have to spend an extensive amount of time itemizing and figuring out replacement costs. I usually would do a blend in this way. I take the square footage and determine the common standard of replacement, then I ask a few basic questions. What would it cost if you have a loss and have to replace the following items? Jewelry and furs, firearms, goldware and silverware, electronics to include TV, stereos and speakers, fine arts, antiques, rugs and collections, computers, both hardware and software, cameras and camcorders, business property including inventories and samples, office equipment, office supplies. Once an amount is determined, I will take the total amount times it by 2.5, then compare that with the amount determined by the total square footage and go with the larger amount. The reason for this is the standard many times does not take into account those who enjoy high-end products, are collectors, or have very specific expensive hobbies. I know that this is not the exact science, but shy of going through itemization, this is a happy medium to help clients determine their coverage for personal property. It also helps you as the advisor in identifying items that may need additional protection outside of the general policy. As a final note, most policies will offer a depreciated value or replacement policy. I personally would stay away from the depreciated value policy as the client may find themselves at a huge disadvantage should a loss occur. In my opinion, the saving does not outweigh the cost that the client will incur if their personal property has to be replaced. When choosing coverage for the home, it is also important to understand the different options of replacement cost. There are a few options. This is coverage where no matter what the estimate replacement is on the policy, the insured is guaranteed that the home will be made whole without depreciation. This policy was common many years ago, but unfortunately, due to excessive losses from improper valuation, many insurance carriers no longer provide this coverage. Even when you do see this coverage being offered, you would need to read between the lines because usually there is a stipulation that requires a minimum coverage amount to the correct replacement value in order to get guaranteed replacement cost. So in essence, it is not truly a guaranteed replacement policy. Extended replacement cost. This policy allows a replacement cost of the property without depreciation of the home, but only to the amount stated on the policy. The extended part of the policy does allow for a specific percentage of extra coverage should there be some fluctuations from the estimate. The extended amount will vary depending on the insurance carrier and is usually by percentage, such as 10, 20, or 30% of the dwelling coverage. This type of coverage allows good replacement cost, but puts the responsibility of properly estimating the replacement cost on both the agent and the homeowner. This type of coverage is less favorable as it takes the depreciated value of the property as a settlement. A homeowner needs to understand that if this is the route they take, they can be at a huge disadvantage if a major loss occurs, since depreciated value compromises the opportunity to recoup total replacement cost.